Welcome back to Money Made Simple. If you've been saving for retirement, how big will my RMDs be once they start? How much will I owe in taxes when those withdrawals hit? In this video, we're going to walk through a real-world example step by step. What happens when RMDs begin, how the deadlines work, how RMDs can make Social Security more taxable, and what your federal tax bill could look like. Plus, we'll cover 2 smart strategies that can reduce future RMD pain: Roth conversions and QCDs. Let's break it down. What are RMDs and when do they start? RMDs, required minimum distributions, are the IRS required withdrawals from certain tax-deferred retirement accounts like traditional IRAs and traditional 401ks. The reason is simple. You contributed pre-tax money, and the account grew tax-deferred. Eventually, the IRS wants to collect taxes. The most important RMD deadline rule. Here's the part that trips people up. The year you reach RMD age is your first RMD year. And for your first RMD only, the IRS gives you an option. Take it anytime during your first RMD year, or delay it until April 1st of the following year. But here's the catch. If you delay the first RMD into the next year, you still must take your second RMD by December 31st of that same year. That means 2 RMDs in one tax year, which can increase your tax bill, increase how much of your Social Security is taxable, and potentially impact Medicare premiums, IRMAA. So in many cases, taking the first RMD in the year is due can be the more tax-friendly move. Example, $1.5 million IRA at age 73. Let's assume you're turning RMD age in the year your RMDs begin. Your IRA balance on December 31 of the prior year is $1.5 million. You decide to take the first RMD in the first RMD year. To calculate the RMD, the IRS uses a factor, distribution period, based on your age. So the calculation is RMD equals prior year-end balance divided by IRS distribution period. Using the standard IRS factor for that age, the first RMD comes out to roughly about $56,600, around 3.8% of the account. And yes, this amount is generally taxed as ordinary income. Now let's add Social Security, because this is where the real tax surprise often happens. How RMDs can make Social Security taxable. Let's assume a married couple, filing jointly, both receiving Social Security. $2,000 per month, each equals $48,000 per year total, and they take the $56,600 RMD. No other income. To determine how much Social Security becomes taxable, the IRS uses provisional income, which is provisional income equals AGI plus tax-exempt interest plus 1/2 of Social Security. In this scenario, AGI is mainly the RMD. Tax-exempt interest is 0 plus half of Social Security benefits. That puts provisional income well above the level where up to 85% of Social Security can become taxable. Important note, up to 85% doesn't always mean you hit the full 85%. It depends on the IRS calculation. But in this example, a large portion of the Social Security benefit becomes taxable once the RMD is included. What the federal tax bill might look like after calculating taxable portion of Social Security plus the RMD minus standard deductions, including the additional amount for age 65 plus. This example results in taxable income landing mostly in the 10% and 12% brackets, a federal tax bill around $5,000, rough estimate, based on the assumptions. The exact number varies depending on deductions, other income, state taxes, and filing details, but the big takeaway is clear. RMDs can trigger taxes in 2 ways. They add taxable income. They can cause more of Social Security to become taxable. What happens after your first RMD? Once RMDs start, they continue every year. And over time, the IRS factor gets smaller as you age, which forces larger withdrawals, and if the portfolio grows, The dollar amount of RMDs can rise even faster, so even if you only withdraw the required minimum, RMDs can still increase with time, especially if your investments continue growing. That's why people worry about RMDs draining the account. But the truth is, if your portfolio is invested and earns returns, it may continue to grow even while you take RMDs. The bigger long-term issue is often taxes, because growing accounts can create larger future RMDs. Can you reduce future RMDs? Yes, and two of the most powerful tools are: 1. Roth conversions. A Roth conversion means moving money from a traditional IRA 401k into a Roth IRA. You pay taxes on the conversion now, but the benefits are big. Roth IRAs generally have no RMDs. During your lifetime, qualified withdrawals can be tax-free, and it can reduce future taxable income from RMDs. The strategy works best when done before RMDs start, especially in years when your income is lower. But watch out! Conversions can also increase provisional income, making more Social Security taxable, increase Medicare premiums at certain income levels, and increase your current year tax bill. So the goal is usually to convert strategically, often filling lower tax brackets without jumping into higher ones. 2. Qualified charitable distributions, QCDs. If you're 70 and a half or older, you may be able to send money directly from an IRA to a qualified charity as a QCD. Benefits: counts toward your RMD, reduces taxable income, no need to itemize to get the benefit. Great for retirees who already give to charity and don't need the RMD. The RMDs are a normal part of retirement when you have traditional retirement accounts. But with planning, they don't have to become a tax nightmare. The earlier you plan, especially with strategies like Roth conversions and QCDs, the more control you can have over taxes, Social Security taxation, Medicare premiums, and long-term retirement income flexibility. Do you expect to face RMDs? And are you considering Roth conversions or QCDs to reduce future taxes? Drop your thoughts in the comments. If this helped, like the video, subscribe to Money Made Simple, and share it with someone planning RMDs.